Back to the markets now, with Treasury yields pulling back just a bit from multi-decade highs, but the 10-year still there, hovering above that 4.7% level. Of course, we are looking at peaks we haven't seen since the 2007 financial crisis. The 30-year yield briefly traded above the 5% level right now at 4.9% right now. This sell-off in bonds triggered by the bet that interest rates will remain higher for longer, given the resilience in the U.S. economy. Now, private payroll data from ADP this morning pointed to a sharp slowing in hiring for September. Investors will be looking to Friday's jobs report for more signs of cooling. Let's bring in Dana Diaria, Investnet Co-Chief Investment Officer. I'm good to talk to you today. So we have seen a bit of a pullback here in yields. Certainly that story far from over, given the ADP data that we got today. What do we glean from it in terms of what we could get on Friday?
Yeah, well, it does seem that we're getting some mixed signals on employment, I would say, right? I mean, employment has obviously bolstered this economy for a long period of time now, empowered the Fed to raise rates. And when the Fed talks about, hey, we're looking very closely at the data, employment is clearly, kind of top of the list. But some mixed messages, right? The ADP report, the JOLTS report. I think what you take, the high level takeaway is that, yeah, we are starting to see some cracks in the labor market. You're starting to hear financials, layoffs in the financial sector that maybe had been held off to a certain extent. But overall, the labor market still hasn't shown the kind of cracks that I think would prevent the Fed from looking at another rate hike. And, that's where the market's worried. I think we're in this period again where good news is actually bad news because the market assumes then it means another rate hike is coming.
And Dana, we've seen some of this bond strength, the domino effects in some of these other markets, including Germany's market as well. But I want to ask you, in terms of how this is informing what's happening with equity markets and corporate bonds, what sort of spillover effect can we expect here?
I think it's been a little bit, surprising. I mean, coming from the perspective of, retail advisors and clients and owning, public market equities and bonds and this tried and true kind of formula where the bonds will diversify the equities and act as ballast. And of course, we're seeing once again that that's not necessarily the case, right? But I think the interesting thing is that when there's turmoil in bond markets, it absolutely can spill over into equity markets. So that hoped for, negative correlation is not there. I think bonds, if it's an equity market problem, bonds, maybe more likely to, be that buffer that folks are looking for. But the turmoil is coming from the bond market. I just don't think that it's that surprising. We've had a year of the equity market saying everything's great, soft landing. And now the equity market is starting to price in, well, maybe not. Maybe, economists keep kind of pushing forward this expected recession. Maybe it's coming. I don't think it's surprising at all that we're seeing the bond market start to price in both the effects of, okay, well, it looks like growth is somewhat on track, but also possibly just this higher for longer, right? And taking the Fed at its word.